Hello, today I would like to walk you through a very profitable strategy, options trading strategy that I've been trading for about 1.5 years. This trading strategy is called the wheel strategy. It's very low risk and it generates great returns. So if you think this strategy is a strategy that will make you 10 times, 100 times your account, no, this wheel wouldn't make you generate that kind of profits. This wheel instead would allow you to beat the S&P 500 consistently. So here I have my account. I show you my 1 year performance. You can see here that where this wheel strategy truly shines is during the down markets. The S&P 500 dropped quite a bit, but there's only a small negative when I traded the strategy. And when the S&P 500 grew back up again, my portfolio again picked back up as well. So this strategy will most likely profit in terms of down market. So when the market goes down by a lot, your portfolio will go down, but not as much, as you can see from this chart. When the stock market is neutral, your portfolio using this wheel would generate great profits. And when the stock market is slightly bullish, your portfolio would also outperform it. The only time where this method wouldn't outperform the general S&P 500 market is when it's a strong bull market, because basically you'll see later, I'll explain, your profits are capped. So without further ado, let me tell you more about this strategy. So I'm basing my entire video on this Reddit post, a very good Reddit post by Scottish Trader. I'll definitely encourage you to read on this Reddit post in detail. It talks a lot about the strategy in detail. Even though it's long, it's not as complicated as it is, but it does assume you have some very basic options knowledge. So let me jump right into how you trade the wheel. So the entire goal of this wheel strategy is to collect premiums. So you could think of it as selling insurance. So you're like an insurance company here. You are selling insurance to people and you take on that risk. And in return for taking on that risk, you get that kind of insurance premium that people pay to you. So the goal is to collect these monthly premiums, and that's how you get a monthly income. So the first step on this wheel method is to sell cash secured puts. And by cash secured puts, what I mean by cash secured puts, it means that you have enough money in your account to buy the shares in the event that you are assigned. I'll explain more of that in detail. But basically, after you buy cash secured puts, there are three outcomes that could happen. Firstly, the options expire worthless. So this is the best option that you can have, because that means it expires worthless. You don't have to do anything. You get to collect the premium. Second, you can also buy back the cash secured put options for a slight profit. So if you think that, you think you think you're going to lose money later on, you can just, like, for example, make 50% profit and just keep it and just close it. Thirdly, you get assigned the stocks. So basically, your cash secured put becomes activated, and then you get assigned the stocks. But it's not the end of the world, because if you get assigned the stocks, you then move on to step 3, which is you sell covered calls to get rid of the stocks that you own. So let me just go through each step in more detail. So the first step is to sell cash secured puts. So basically what a put is a contract that gives the person a right to sell that stock at a particular price. So I repeat, if you buy a put, it gives you the right to sell the stock at a particular price. But here we are not buying puts, we are selling the puts. So we are giving people the right to sell their stock to us at that price. Okay, so I'll go to Thinkorswim here for an example. So here is Thinkorswim. You can see these are basically the dates which I can buy my options. So the few things to know about options is that this is the option expiry date. So at or after this date, or at or before this date, a person might exercise it. If I click into it, let's say 22 August, you can see there are a lot of prices and a lot of what I call the strike price. So this is the strike price and this is the buy and the bid pricing. So how I sell a cash secured put is that I would choose a strike price. Usually I would choose a strike price between 20 to 30 delta. And if you look here, 32 days, I would typically sell a cash secured put around the 30 days date to expiry. So that's what I'll completely do. So around 126, I would say 20 delta and 32 days options. So the strike price 126, why this is important is if the share price, let's say currently Airbnb is traded at 138, if the share price drops below 126, I get assigned the shares. So it's good to note. So if you go back to the PowerPoint that you move back in the video to PowerPoint I shared, you could see that the third scenario, you only get assigned if the share price go below 126. If it stays above 126, you get to collect the premium. Now you might ask, how much premium do I collect for taking this risk? And that's where the price comes in here. So if you can see, it's usually an average between 149 and 240. That's your premium price. So if you take about, I would say 1.9, so 1.9 is roughly equals to $190. So all you have to do is, in theory, all you have to do is wait 32 days. If the options expire above 126, you get $190 just like that. Sounds simple? Yes, because it's simple. And so we covered the first step, 1A, which is if it expired worthless, you get to keep your $190 premium. Second, when would you want to sell early? So this is more an art than a science. It's basically up to you. Some people would collect their premiums once they hit 50%. So remember the full premium's 190. Like let's say once you have £100 of profit, you might close it. Or if you see suddenly there's a huge jump in your profit in 1 day or 2 days, like you suddenly make £100 in the first 2 days of selling these options, you might choose to close for a profit as well. The main reason is because there is very little left to earn. And the third unlikely situation that you don't want is where the price goes below 126, and that's where you get assigned the options. So again, I want to emphasize here that it's very important to make this a cash secured put, which means that you have money in your account to buy in the case of option assignment. So how much, you might ask, how much must I buy the shares for? So you're going to buy the shares, let's say if it drops to 122, because you're selling a put, you're going to end up buying the shares at 126. And because each option contract is 100 shares, you must spend at least $12,600 to buy the shares. So I need to have at least $12,600 in my account if I want to sell one Airbnb contract. That's why it's advisable to have an account of at least, I would say, $20,000 if you want to trade this strategy. The more amount of money you have, the safer this strategy becomes. So now let's look at analyze. So basically this analyzer allows you to visualize what is your profits. I want you to focus on the blue line. So the blue line here is basically what your profit is at the date of expiration. So I can see here 149, here 149. So at expiration, let's say it's 149 instead of 190. You can increase it to 190 here as well. No problem. It will most likely get assigned. I can see that at date of expiration in 32 days, I can see the blue line shows 190. You can see at the bottom left corner. That's the profit I would earn. So the only issue is if it drops below 126. You can see if it goes below 126, I start losing money here. But no worries, because it's very unlikely that it will drop a lot. Firstly, it has to drop at least 10% for you to get assigned 126. So that itself is very unlikely. Secondly, even though it drops, you can still hold on to the share. That's why it's very important to only sell cash secured puts on share you don't mind holding, because sooner or later, one of your trades, you will end up holding it. So again, very important to be comfortable holding that stock that you're selling puts on. So what happens now if you get assigned the shares? So if you get assigned the shares, then what you can do is, let's say you get assigned at 126. What you can do is you start selling covered calls. So what you can do is, instead of this side, you move on to this side, you start selling covered calls. So covered calls means it's the opposite of puts. It gives the person who buys the call an obligation to buy that share at that particular strike price. So it's the complete opposite of puts. If you don't know what puts and calls are, I'll advise you to watch one of my very early videos on what put and calls are. So the goal of covered calls here is to get rid of your shares for a profit. You want to get rid of it as fast as possible if you get assigned the shares. So that usually means the smallest date expiry, let's say 11 days. Let's say 126, 11 days, you're just going to sell it. So as fast as possible for a profit. Because again, the goal of this strategy is to collect premiums from cash secured puts and not to hold stocks and sell covered calls. So now let's discuss the downsides of this strategy. What can you expect to not gain or lose from this strategy? So there are two main downsides. So if I go back to this analyze chart, you can see the first downside is if the share price drops a lot. It's currently trading at 138. If it drops all the way to 126 and below, you will lose money. So that's the only instance you will lose money. It's not such a bad thing, because if it's a stock you want to hold, you would buy it at, and you think it's a good price at 138, then you're buying it at a lower price. So it's a good thing. Secondly, the other bad thing is that your profits are capped. So imagine if at 138 the stock price increased to 150, the only profit you would make is capped at 190. You won't earn more than that. So your profit is capped, and you get the stock price might drop. So those are the only two risks. So in summary, if you're running out of ideas, or if you are looking for a very profitable strategy to trade, I would definitely highly recommend the wheel strategy. So if you look at my portfolio, I've been trading 1.5 years. I really liked it. It's very safe in terms of market downturns. Even if the market dropped 10%, I would still be earning money, because as you can see here, I might not get assigned even if it drops 10%. And even if it drops more than 10% and I get assigned, I'm buying the stock at a discount. So the pros of the strategy, I get to buy stocks at a discount, I get to collect premiums if I don't get to buy the stocks, and it performs very well in neutral, slightly bullish and bear markets. Thank you.